Welcome back to Asset Informant, where we bring you the latest insights and trends in the world of finance and investing. In today's video, we'll be discussing the best long-term dividend stocks to buy now. If you're an investor looking for a stable source of income that also has the potential for capital appreciation, then this is the video for you. We've done our research and identified some top picks that have a proven track record of delivering reliable dividends, strong financials, and a solid business model. So sit back, grab a pen and paper, and get ready to learn about some of the best long-term dividend stocks to buy now. So before we continue, please subscribe and turn on the notification to keep the videos coming. Number 1. RTX. Raytheon Technologies is a diversified aerospace and defense industrial company formed from the merger of United Technologies and Raytheon, with roughly equal exposure as a supplier to commercial aerospace manufacturers and to the defense market. The company operates in 4 segments: Collins Aerospace, a diversified aerospace supplier; Pratt & Whitney, an aircraft engine manufacturer; Raytheon Intelligence and Space, providing a mix of sensors, hardware, and communications technology; and Raytheon Missiles and Defense, a defense prime contractor focusing on missiles and missile defense systems. The exciting thing about aerospace and defense giant Raytheon Technologies in 2023 is how it's setting itself up for excellent medium and long-term growth. Raytheon generates around 55% of its revenue from aerospace and the rest from defense. The Pratt & Whitney segment, 29.2% of 2022 sales, and its commercial aircraft engines are fascinating. Aircraft engines tend to come with a negative margin, meaning they are loss-making. While that would seem to be an insane business model, not least because it takes billions of dollars and many years to develop a new large commercial aircraft engine, the real money is made in the lucrative aftermarket. Aircraft engines tend to be used for at least a few decades and are subject to shop visits where they are overhauled for maintenance. So the more engines delivered now, at the cost of near-term profitability, the more long-term earnings that are generated through aftermarket revenue. As such, Raytheon investors should welcome increased deliveries in 2022 and so far in 2023 for Pratt Geared Turbofan GTF engine, one of the 2 options on the Airbus A320neo family of airplanes. Number 2. MSFT. Microsoft Corporation is one of the largest broad-based technology providers in the world. The company dominates the PC software market with more than 80% of the market share for operating systems. The company's Microsoft 365 application suite is one of the most popular productivity software globally. Although overshadowed by Apple in recent years, Microsoft undoubtedly remains one of the most successful technology companies of all time. As part of the technology old guard, Microsoft has already experienced a period of high growth and established itself as a market leader as well as one of the biggest companies in the world. However, Microsoft continues to record impressive financial performances every year, and this year has been no exception. Microsoft has had an incredible history on the stock market since its debut back in 1986, reportedly creating thousands of millionaires amongst employees who wisely accepted stock options as part of their compensation in the company's early days. Furthermore, unlike many younger tech companies, Microsoft pays a reliable quarterly dividend, which is currently 0.62 cents per share. At the current Microsoft share price, that represents an annual dividend yield of around 1%. This may not seem like a lot, particularly given rising interest rates, but it's a reliable source of income, which is consistently growing, doubling in value since 2015. However, there is no escaping that the outlook for the global economy remains uncertain. Microsoft shares may continue to fall before they recover, if they recover at all. Therefore, anyone considering investing in Microsoft stock should be braced for ongoing volatility and ensure they take steps to effectively manage their risk. Number 3. SAP. SAP is an independent software vendor and a leading provider of enterprise resource planning software. Its solutions are designed to cater to the needs of organizations ranging from small and medium businesses to large global enterprises. Per a report from Fortune Business Insights, The global enterprise resource planning software market is projected to grow from $49.28 billion in 2022 to $90.63 billion by 2029, at a CAGR of 9.1%. SAP's performance is being driven by continued strength in its cloud business, especially the new Rise with SAP solution, across all regions, as well as momentum in SAP's business technology platform, particularly with the S/4HANA solutions. In the last reported quarter, the current cloud backlog, a key indicator of go-to-market success in cloud business, increased from 27%, up 24% at CC, to €12 billion. Also, SAP S/4HANA's current cloud backlog was up 86%, up 82% at CC year over year. The company recently announced that it plans to conduct a targeted restructuring program in certain areas of the company. The goal of this program is to better align its operating models and go-to-market approach with its accelerated cloud transformation, as well as to strengthen its core business and improve overall process efficiency. In March, the company announced that it had entered into a collaboration with Silver Lake and Canada Pension Plan Investment Board to sell its stake in Qualtrics for approximately $7.7 billion. The potential sale would allow SAP to focus on its core cloud growth and profitability while allowing Qualtrics to continue its growth and leadership in the experience management category. Prior to that, the company announced the next generation of its SAP Data Warehouse Cloud solution, SAP DataSphere. The solution is designed to aid data professionals in delivering quick access to vital business data across the organization's data landscape without compromising on business context and logic, added SAP. Number 4. Pfizer. Pfizer is also one of the top companies when it comes to research and development, with new products continuously being released. This makes it an attractive stock to own for the long term, as a potential upside from new drugs or treatments could mean strong returns down the line. The stock seems to offer a good value, as Pfizer's GAAP trailing 12-month price to earnings ratio of 7.6x is considerably lower than the sector median of 24.95x. Income investors should also be interested in Pfizer, as the company pays a forward annual dividend yield of around 4%. Generations of investors have trusted Pfizer to continue paying healthy dividends, and it appears that the company is still committed to this. Moreover, Pfizer's pipeline of products in 2023 will expand far beyond COVID-19 vaccines. The stock seems to offer a good value, as Pfizer's GAAP trailing 12-month price to earnings P/E ratio of 7.6x is considerably lower than the sector median of 24.95x. Income investors should also be interested in Pfizer, as the company pays a forward annual dividend yield of around 4%. Generations of investors have trusted Pfizer to continue paying healthy dividends, and it appears that the company is still committed to this. What about growth, though? Pfizer can't count on the COVID-19 pandemic as a catalyst to generate revenue anymore. However, the company is still advancing Paxlovid, a proposed treatment for certain high-risk adult COVID-19 patients. Pfizer asserts that COVID-19 continues to cause significant burden in the U.S. as case rates fluctuate and new variants and subvariants emerge. So even if the WHO ends COVID-19's pandemic status this year, Pfizer might still be able to generate robust revenue from Paxlovid. Number 5. SPGI. Acquisitions have always carved a key growth trajectory for S&P Global. The recent buyout of IHS Markit is expected to enhance its data and analytics offerings. Another acquisition of the Climate Service is expected to enhance SPGI's portfolio of essential environmental, social, and governance insights and solutions. We are impressed with S&P Global's endeavors to reward its shareholders through share purchases and dividend payments. In 2021, S&P Global returned $743 million to its shareholders in the form of dividend payments. However, it did not repurchase any shares last year due to the pending merger with IHS Markit. In 2020, SPGI returned $1.8 billion to its shareholders, $1.2 billion through share repurchases, and $645 million as dividend payouts. In 2019, S&P Global returned $1.8 billion to its shareholders with $1.2 billion as share repurchases and $560 million of dividend repayments. SPGI's revenues are anticipated to grow 40.7% and 6.6% in 2022 and 2023, respectively. Shares of SPGI have jumped 4.2% in the past 3-month period, compared with 0.3% rise of the industry it belongs to. Such shareholder-friendly moves underpin S&P Global's commitment of creating value for its shareholders and underlying its confidence in its business. These initiatives not only raise investors' optimism on the stock, but also positively impact the earnings per share. A key risk. S&P Global's current ratio, a measure of liquidity, at the end of third quarter 2022 was pegged at 0.83, lower than the current ratio of 1.26 reported at the end of second quarter 2022 and the prior year quarter's 2.26. Decreasing current ratio is not desirable, as it indicates that the company may have problems meeting its short-term debt obligations. And that's a wrap for today's video. Remember, investing in dividend stocks is a great way to build wealth over time, and these stocks can provide a steady stream of passive income for years to come. But it's important to do your due diligence and research each stock thoroughly before investing your hard-earned money. If you enjoyed this video, please give it a thumbs up and don't forget to subscribe to our channel for more informative content on investing and personal finance. And if you have any questions or comments, feel free to leave them down below. As always, thank you for watching, and we'll see you in the next one.